This is the Collecting Real Estate Podcast. I'm your host, Stephen Purse, here with your co-host, Bill Hamill.
I'm somewhat more comfortable collecting real estate than I am collecting other stuff.
This is the Collecting Real Estate Podcast. I'm your host, Stephen Purse, here with your co-host, Bill Hamill. We interviewed Mike Taravella from Rand Partners this morning. Bill, what'd you think?
Mike's an impressive guy. He's been doing the scaled up version of multifamily only for 3 or 4 years, but talking to him, I think that he can fill any bucket in this business. I know he's an expert underwriter, expert asset manager, expert networker. So Mike has a lot to offer.
Yeah, a lot of good points in here. I liked one line he said, staying aggressively patient. He's got accounting experience. He talked about apartments being a human basic need, how he stays in rent growth markets, and how he faced people doubting him going into real estate, like his coworkers and his family. A lot of good stuff there. Mike Taravella, thank you for being here this morning. Excited to hear more about your real estate journey. Let's get right into it. How did you get into real estate?
Well, I was a terrible accountant for 5 years and realized that accounting was not my way to success and financial freedom. So, I graduated college in 14 with my master's of accounting. We did a screen printing company in college, so I was waiting for the downturn to happen, but here we are in 2022 and it still hasn't happened yet. And I wanted to invest in a business that was a human basic need. I'm a terrible cook. I know nothing about food. I was almost like 300 pounds. So I'm like, well, that's not it. Clothing, I already did screen printing. And I was like, that's probably not it. And so I was like, all right, housing. So I did a single family. My ex was like, why don't you buy our house? We broke up. My coworkers in public accounting were like, who would want to do business with you? And I'm like, well, I'll find someone. And when I closed on my first house, my mom cried. Not in a good way, going, you're going to lose all your money. So when you follow the path of success like that, I guess, your circles change. I evolved. It was great because I got the experience that we're talking off mic of Bill and managing it. But the problem was I can't fix anything. If it's not on an Excel spreadsheet, I'm the most useless human on earth. So shout out to my dad for fixing everything and helping me. I held the flashlight professionally for the 4 years that I held the properties. But the pain point was I worked for Dan Gilbert and working with his startups and helping them scale their businesses, but I wasn't taking my own advice when it came to my real estate portfolio. So it's just super important that I just realized that because I'm like, I had to take a week off work. I have to fix the properties. I have to do all these things. And it just wasn't my highest and best use. So went to a meetup in Chicago with John Kasman, opened my eyes to multifamily. Took 6 months of just education. I call it the 10 p.m. to 2 a.m. shift, where I would just underwrite a deal, try to start a podcast, network my face off, and just really tried to learn. I was even underwriting for free because I didn't know how. And then I got the call to join Rand Partners 3 years ago. It'll be in June. And we've closed on 40 million. I was the asset manager / analyst, but now we've been a part of 40 million plus, and I'd say closer to 50 now, in million in real estate transactions, and I'm overseeing the 1,500 unit portfolio, 1,500 unit portfolio that we've had, and building those systems that I've worked with startups before, and just helping scale and make the portfolio more profitable. So
Excellent.
here we are.
Great to have you today, Mike. I'm excited for this episode, and we can certainly get into real estate and scaling into real estate momentarily. I know Stephen probably has a lot to say about that, but I've listened to you for a couple years now, and I've always been impressed. And a lot of the times we fall into personal development on this show as well. And seeing what you just mentioned on a few things, buying those single families, that common theme, people jump into single families, figure out that scaling is the way to go. And your mom cried. I know my parents were extremely concerned when I bought my first 2-family at 21 years old because I was a bad college student, and they were convinced, what are you doing? You were going to fail. And it's funny in that personal development space where I had that why at that point, and I was not going to fail. Here I am 29 years later, still in real estate. One thing that I heard you say, and it brings me back to listening to, you were on a podcast, or it was your podcast, being 300 pounds as that CPA. And I remember the story. Please elaborate a little bit. I remember you playing basketball, and that
Oh
was.
yeah, we talked about this at the boot camp. Yeah, so I was 200, like probably 280. It's a pretty sexy story of just studying, eat, work, eat, like no movement in my life. And so, yeah, I would play basketball, which I was never a basketball player, and literally just played with former college athletes and who played at the collegiate level. And you learn very quickly how not to play, and just would play every morning before work at the Quick Loans, like family of companies. So it was just a fun time. And because I was 23, I was having chest pains, which I'm like, that's not a very good lifestyle to be living if you're like, oh, I'm gonna die. Like the heart, like I listened to the Gary V's like, you're gonna die, and that like video that went viral, and I was like, oh, that's to me, because I'm literally going to if I don't get my health in order. So I just was doing that every morning, playing with the guys, and it was just like a fun way to network and interact with people who were in different market or different sectors. Like there's mortgage brokers, there's VPs, there's just like across the board, and just telling them what I was doing in real estate, but also playing, and just it was just like a fun way to exercise and have that like social accountability. So then I ran marathons, not as fast nearly as Bill, but check the box on that, and did it without headphones. So I like to push myself in like all aspects to physically, mentally, underwriting. So one would say I'm not good with balance. We'll say it's all extremes.
It all goes together, pushing yourself, whether it's a marathon or taking that 10 p.m. to 2 a.m. shift, doubt or not listening to the people that are doubting you. Like Bill mentioned, you had your mom crying, you had your coworkers, your girlfriend saying, "What are you doing?" But you knew what you were doing, and you went forward, and you did it well. I also liked the human basic need part that you mentioned. I tried to do a clothing company for a couple of years, and it's very different making a consumer discretionable item versus a basic human need, something that people need every day. That's why we love multifamily, we love real estate. Going back to your accounting background, we love CPAs. I think they're useful on any team, whether it's a syndication, JV, whatever it is. How do you use your CPA accounting background in this multifamily real estate investing world?
Yeah, so my background was auditor, so I've just been the term in accounting is it's professional skepticism of just making sure always asking questions, which in my opinion has probably been more of a detriment. But I just ask a lot of questions, and not to the point to the broker where I'm be will like being a pain in the ass, but it's just making sure I understand everything that I see when it comes to the deal, right? Is it cash versus accrual basis? Not many. When I came into the industry, not many people knew it. Even when I started underwriting, the first number of gross potential rent was so foreign to me because I go, this is a made up number. Anyone could put like $1 million, $2 million, $10 million as gross potential rent. So it just really allowed me to just see the holes of the financials, because in accounting, all you're looking at is 5 years of just 5 years of school, 5 years of professional work experience. All you're doing is studying T12s. Even in the audit, you're seeing how they came to that number, which a lot of people, it's black and white in accounting, but there's some rules and disclosures and documenting. So even in my underwriting, and I'm sure Bill has seen me underwrite, I'm super, I document it as if like Bill could pick up my underwriting and understand how I got to my numbers. Steven, if you saw it, you could see how I document even every analyst. I go, if you don't document and put the link to where the property taxes are or how you got to that number, I'm sending it back. It's like one of the first things I check. So um, it's a trust but verify system, and I've used that like to skepticism, which in the last 5 years. If you just kind of bought anything, it worked out. But uh, we've missed out on probably more deals. But I feel much more comfortable, and I'm still working on it, flexing the balance of accounting and finance, because accounting you're looking backwards, finance you're moving forward. But I think it's just an incredible dose of skepticism, we'll say.
Yeah, coming from that auditing background, you probably started off, and I think you touched on it a little bit, being probably very, very conservative on that underwriting side, being
Oh yeah.
very skeptical. Tell us how you've evolved. I'm sure that you've gone from conservative to somewhat aggressive. You're in a market that has serious rent growth. It continues to have that rent growth, and you're trying to get deals no differently than other investors trying to get deals. So if we stay super conservative, you never get the deal. So tell us how you evolved that way.
Yeah, I think it's through seeing operations. So obviously, with our background, we have an internal property management company. So we're seeing 1,500 units worth of experience. Plus, I think it's like the paradox of seeing the more deals you do, the more experience you have, the less worrisome you are. But I think the biggest thing that, looking at one number is not going to break you when you're underwriting. It's a larger macro event. So I'll underwrite a deal and I ask myself, why does this deal fail? I got that from Ray Dalio in Principles, because it's not going to be like your administrative expenses go up. Everyone talks inflation. Like if any of those one numbers breaks a deal, it's way too thin. It's going to be a more macro thing. Is the market too small where we don't have property managers? Is the median income too low and not growing? Is the population declining and there's not enough demand in the area? So paradoxically, I've kind of taken a more a mental map of like, is it a growing area? Is there good job growth? Is there a delta on the rents from now to where they could be? We're focusing on newer products. So there's a lot, like you said, Bill, a lot more competition just because the 60s products are so old and the plumbing and like I'd rather pay more for a newer product that won't have plumbing issues than a 60s build so I can get more cash flow and have to deal with all of the management nightmares for it. So the mental seeing the mental model repeat and just seeing deals. Obviously, values have gone up in Tennessee because we focus primarily in Tennessee, Kentucky, Huntsville, Alabama, which are all very hot markets. But when you underwrite everything for the last 3 years, you get quicker with it and just seeing those discrepancies.
Mike, earlier you mentioned that you would give others advice on how to scale, but when you looked internally, you didn't see that same advice being applied to your own business. What changed there and got you to start scaling?
Um, it's a great question. I think the biggest thing was I would literally have to take a week off work every time I closed a house, and then I would have to wait a year to replenish my capital to buy another one. And in my head, I was like, there has to be a better way. And I was working with these startups, telling them like they need to do these things. And so literally I would go home and I'm like, well, I don't have money in my bank account to buy another property. And so I just was just asking like, how could I do this? And I wasn't saying like, how do I buy 100 units? Like I was just like, how do people do this? And, scouring bigger pockets, going through that. And I connected with John Kasman. He was working Metro Detroit, moved to Chicago, doing what I wanted to do, and I was looking to move to Chicago as well. So we connected. He just opened my eyes to the opportunity of multifamily. I'm like, oh, so you don't have to have. It's not a no money down, so I don't want to say that, but it's your leverage. When you syndicate, you're using other people's money to purchase a property for profit, or it could be anything. Most of the Broadway shows are syndicated. There's a lot of things that are syndicated that you didn't know, so it's not a new term, but now it's becoming more common with investing vehicles and everything like that. So it was a pain point of looking internally of just saying, I'm helping these business skills very quickly. and I know I'm more sophisticated and savvy, so I have to. How can I continue to grow and scale my real estate portfolio? So it was just kind of looking internally at myself and what I was doing and going, there's got to be a better way.
So you went from the single families, realizing there's going to be a better way, jumped in with John Casman, which I'm sure provided fantastic insight. Was it at the same time that you got that offer from Rand where you're able to join their group? And, tell us about your next purchase after the single families. Was it before you joined Rand, or was it after joining Rand and beginning your journey there?
Yeah, so I committed myself to education, and that's like I read Joe Fairless's book, the best ever book on how to buy apartments. I read that in a weekend. I applied it immediately. Was trying to underwrite LoopNet deals. I was trying to connect with people who've done real estate because Bill, you know me very well. I'm a social butterfly, which probably is why I didn't fit into the accounting world. But I just connected people. That was my value add to people. Like, you do deals in Milwaukee, I know this person's doing deals, and would connect them. And so I was just trying to continue to connect. And I went to the best ever conference in 2019. And one of my friends was like, I think you met every single person. I got averaged 4 hours asleep a month before because I was trying to ramp up my branding and stuff. But I just committed to education. And so, and I was underwriting for free. So then when I got the offer to join Rand, I hate this part of the story, but uh, within the first week, we got a deal under contract that I was like one of the last deals I underwrote before moving to Knoxville, which is 143 unit, but I own point the very very like less than a point in equity. So I don't want to say it's like I bought this huge deal and flex on that. I own a very small part, but it got me in the game, got me experience, and then it was I think now we're up to 400 plus units, and it's just been exciting because I think a lot of people think like your first deal you're getting financially free, but what's happening is you're gaining more equity the more deals you do because you have more experience that you can execute on it. So it's 143, then a 52, a 48. This past quarter, we've closed like 44 deals in like 40 days, and we have a refi closing today. So it's been fun.
Once that ball starts rolling, it starts going downhill and growing and growing. If you're describing yourself as a networker and connector, I think you made a good industry change. I'm wondering if you have the networking skills, you have the underwriting skills, and when you're talking about showing your work, I was getting like middle school math teacher telling me to show my work flashbacks. I never wanted to do that. I like just putting the answer down, but you have the underwriting skills, you have the networking skills. You touched on property management. What does your day-to-day role look like for Rand?
It's a lot, right? So I've been really dialing in on my critical numbers. Even today, I've been working on this like a note card of just like who am I calling, right? Because my like accounting background really helps with the asset management, so I can see a T12 and find the pain points and go. So generally, trying to call 5 brokers a day, underwrite 1 to 2 deals a day, and then try to build a system a week of helping. So that in December, I hired a virtual assistant. She took my workload from 5 hours of my 36 unit I bought down to 1.5. I'll say 1.5 rounding up. But uh, I realized that I can't do everything and you don't want to do everything. And leverage is such a critical piece. Like, think of the top investors, CEOs, they're leveraging either their brand, their people, their capital, and just scaling and people. So I needed more leverage in my life. So I hired a virtual assistant in December, had her on a lot of calls and invested a ton of time. And now she does most of the work on the data entry for my asset for the property. But I can quickly pinpoint what we need to do because she's showing the numbers. Um, so uh, underwriting, calling brokers, trying to build a system, and then kind of just follow up with our deals that we have and making sure they're executing. As like the asset manager, you're like, how could we do this better? Which no one in property management likes, because like if you got rents at 1,000, could we have gotten 1,100? So it's like kind of that. How could we operate better every day? Which because it never feels like it's good enough, but the market is changing so quickly that you just have to mitigate your downside risk as much as possible.
So is it fair to say on a day-to-day, I know you're working with Rand, but you also have your personal investing happening as well. So, you're left having to divide, your personal business along with what your responsibilities at Rand are. I know, getting to know you, you have a large role being the asset manager for all of those Rand properties. What is your concept there? We tend to, in the business, say I went from a property manager to an asset manager of, at this point, about 250 apartments, and we so typically say I'm managing the property manager. And
That's my biggest
tell us your
misconception.
concept
I
on that. We know you have a little bit
I
different
hate that.
version of
I hate
that.
that. Yeah. So it's I think the biggest thing is the asset manager, and a lot of people in the you know in our system, in our networks, try to be like I manage this person or this team, but really it's like you're collaborating with that person. Doesn't matter how much I yell at my property manager. If a bill is going to cost $1,000 and I underwrote for $600, I can't. It's not on them. That's on me. So I think it's like the asset manager is like you're the accountability officer and making sure that's getting done, right? So you're working with your property manager. It's a give and take. Obviously, as you're pushing rents, you're reminding them that it's more profitable for their business because they're getting higher fees. But you have to sometimes tell the property manager because it's your business. Because you, as the asset manager, are going to have to go to your investors and go, hey, we didn't pay the distribution or we paid less. So it's important that you, as the asset manager, run your business how you need it to hit your numbers that you promised your investors. Don't do anything illegal or unethical. But if the property manager is like, I don't want to charge this much in rent, then you may have to find a new property manager, and you have to have difficult conversations. But it's I look at it as a very systemized approach. There's three kind of critical numbers. You have to have your physical occupancy at your market or even higher, but not at 100%, because you're leaving money on the table because your rents are too low. But your physical occupancy should be around market because you need people in the door to pay the rents. And then from there, it's your economic occupancy is the next number I'm looking at, because if you get people in the door but they're not paying, that's a problem. So are you filing evictions? Is there rental assistance that you're not working on? What are you doing to control the delinquencies? And so the last thing is, if you have people in, you have residents paying, your only other real operational risk is that your property manager is overspending. So we always make budgets for the properties to make sure that we're managing the expectations, and we're working with our property managers. I'm not telling them how to run it, and I ask them for their professional, because they're there every day. And so I'm asking them what they need to have to execute the business plan and giving them some insights of what numbers we need to hit. It's not, it's not like run it with duct tape and glue, right? We want it to be running and having a really high level of customer service for our residents. So whatever we can do to help them.
I like the idea of having it be a team sport, but I'm thinking in practical real life situation, you have a property manager who wants to spend more on a project than you have allocated in your budget, and you have a certain limit that you can spend, and you get to that conversation where you have to tell them, no, we can't do that, we can't do that, we only have this budget. How does that differ from management?
Well, so as the asset manager, I mean, you're giving them insights, right? We're not putting golden toilets so it's taking that step back of like, well, how do we get to this goal of profitability without breaking the bank? Obviously, if there's anything that's like severe, that's life endangerment or resident safety, like we have to spend it.
Mhm.
So from there, it's okay. Well, if we have to, excuse me, if we have to buy X, what do we need to make on the revenue side? Like, right? Everyone talks about, hey, utilities went up, pests went up. Well, do we have to change our RUB system? Like, it's all levers, right? So we have to spend X, then we need to make Y. How do we make Y? Do we charge more in rent? Do we charge more in other admin? What does that look like? And asking those, and I can't fix anything, but I ask my property managers, when will this unit be done? I don't know how to fix it, but they will let me know. And then when that date comes, how can we get this done sooner? Or how can we get this done on time? All you're asking is really powerful how questions, because I'm not telling them how to do it. I'm asking them and holding them accountable to that deadline. So it's just for profitability's sake, how do we maintain this level of profitability, or how do we increase occupancy? It's just asking those how questions that can, I think, make your life easier. And that's from Chris Voss. Never split the difference. Is asking those how questions makes your life, because then you're not telling them how to do their job. You're making them think of the solution, and you're working together.
I'm going back in the last building that me and Steven purchased, which has just started the repositioning. We walked that property with our property manager before it was even closed. So I guess a lot of it is being on the same page with the business plan before you go in. So when you begin operations and you're in the middle of the operations, then it's like, well, this is what we discussed before we closed, and we really have to stick to this plan, except, yeah, those things that come up that you have to fix. So, do you guys walk through with the property managers and have that same type of scenario?
Yeah, we walk through everything, but I think we all know when you buy a property, you think it's like, here's the list of things we need to do, but then as soon as you close, three HVACs go out to the first day. As soon as you close, like, stuff just happens. So it's always having like a good buffer reserve rainy day fund, and being well capitalized. I think with prices in our markets, prices are still going up despite interest rates still going up. And so it's just making sure you're well capitalized. I look to have a capex budget for all the units, because you never know. Yes, we want to leave meat on the bone for the next person, but you also don't know what could happen. So if you only raised enough money to update half the units, but then something catastrophic happens, you can't execute your business plan. And so we've seen a couple deals presented off market that's been the case. So we just want to be well capitalized in our deals. So does that mean we're not getting every deal? Yeah, but when we get a deal, we know it's going to be a home run. So it's just, what risks are you willing to take as an investor, and making sure that you can answer that, and also let your investors know what the risks are and how you can overcome them.
Talking about risks and the general state of the market, and earlier you said you'd mitigate downside risks because of market shifts. If your crystal ball is out right now, what do you see shifting in the market? What do you see coming next?
Well, I think I read Billion Dollar Portfolio, and I fundamentally agree with it, because, I mean, with everything going on, we closed 4 deals in 40 days 4 deals in 40 days, and it was 90 units. And that's, one property appraised $1 million more than what we bought it for. One's like a student housing deal we're repositioning, and it's an up and coming area in Knoxville. So, the answer is never to sit on the sideline. You still have to be aggressively patient. And so when the shift occurs, I mean, interest rates went up a whole percent in a month. So we're just making sure that we're underwriting, we're getting fresh debt quotes every time. I stress test it like 10 different ways. So, if we maintain the level of rents today, can we cash flow? That's not always the case, but like, worst case, can we get to that point where we're cash flowing? How quickly can we get there? Do I have I think the biggest thing is, do I have the capacity and the capabilities to execute? So that's like, if in Knoxville, we have our internal property management team, we're doing 8 units a month on a CapEx. I would never underwrite that. And so I'm just making sure, do I have the right team in place to execute it? And do they have enough time and the resources to execute? I think a lot of people will get like, oh, I have a residential person who can dabble in multifamily. It's probably not going to work. That's like also me going to Bill's market and then going, oh, I could do it for half the price as Bill could do it. Probably not, because Bill has his market expertise. And so I'm just doubling down in the markets I know, like, and trust, and just seeing the growth in it and making sure that we can execute the business plan as quickly as possible. Because if you get rents up, your valuations go up, and just making sure that we can execute and pay our investors. So, we're always, losing sleep. I don't want to say we're losing sleep over interest rates, but when you lock in a long-term fixed rate financing, it's not the best, it's not the sexiest, but it's always going to be there, and we don't have as much floating. So, but also in our markets, it's very geographical. So Tennessee, I mean, in Nashville, they're getting Amazon, Oracle, and coming there. In my 36 unit, they announced 2,000 jobs coming. So will it slow down? Probably not soon. But I think debt is trying to slow things down in that aspect. So we're just aggressively patient, trying to find opportunities, because if you sit on the sideline, you're done.
Yeah, and you still have to operate in year 2, year 3, year 4. So we don't know when that uncertainty is going to come around. So I don't care what market cycle that I've ever purchased in, is buying right. The professionals in this business buy right. We insulate ourselves from any uncertainty. Specifically now, inevitably, the market is going to correct. To what degree? It's difficult to say. But yes, over the next year, I agree that there's still opportunity there geographically, spot to spot. But especially when we're syndicating, we still have to stress test refinancing, whether it be 2 years, 3 years, depending on interest rates, things like that. One thing I want to ask you is, when investors are considering our deals, your deals, that big question: how does this deal fail?
Well, like, handling that, I mean, I tell people, like, the reason, like, so, like, my 36 unit, as like a kind of a case study. So I've not been in the market. There was one property that charged over $1,000 in rent for a similar product. It was a little bit older. So, but just seeing the population growth, I think the risk was that rents don't go up higher than what we underwrote, because it's a growing area, but there was only one property charging $1,100 in rents in this market south of Nashville. So it wasn't Nashville, so it's a smaller market, and there's only one property charging $1,100. So the risk for that, the reason the deal could have failed, was that we couldn't get rents to $1,100 because there wasn't that other properties charging that. Today, thanks to a hot market and inflation and everything else, rents are we just got a lease today for $1,350 for one of the older units, and then we have some new duplexes that we were underwriting $1,450. We're getting $1,650 on those. So it being a smaller market, it wasn't Nashville, and I'm not even going to pretend that it was Nashville, but the reason it could have failed is that the rental market wasn't as strong, because they're building a lot of single family homes, but there wasn't a ton of rental products or a lot of comps in the area. So it's 45 minutes from Nashville, so we felt good about management. But I was kind of nervous, because it was like, hey, rents we're shooting for $1,100, which exists in the market, but is that too high? Is that too low? Could we get it? And today we bought that in July, and it's the end of April. So I stand corrected, and it's been going really, really well.
No, and I love that question, because, it's so important to ask the operator. Me and Steven, before this episode, we were having that same discussion. The deal that we're doing right now, we're excited about it. We got into it for that reason. We think that there's a lot of meat on the bone there, not a lot of value add work to do. Places mostly occupied, people are paying, but we have our two vacant apartments that we've just begun doing some simple turnover work, some bathroom work. But that big question is, okay, these had been rented for, I don't know, 910 or 925. Are we going to be able to get our 1250? And the market tells us yes, but that's the only way that this deal does not work, is if we're not able to get the 1250. Yes, did we stress test it? Does it work at 1150 or 1200? Sure. And that's the beauty of being insulated on these deals. So no, I appreciate your answer on that. I think that we're thinking the same thing on these last few deals that we're doing. Mike, this is the collecting real estate show. So they say you have to have three of something to make a collection. So we've got three questions for you to wrap this up. Number
Okay.
one, in 5 words or so, what's the most important thing you've learned since you started collecting real estate?
Believe in yourself.
Awesome. I like that.
I had to do the math, Mike. It reminded me of MM4, and someone's like, that was 5 or 6 words. Oh, man. Embarrassed myself. But believe in yourself. And, if you believe in yourself or around people that are doing it, you're going to do what the people you surround yourself with. So if you believe in yourself and want to buy real estate, surround yourself with people who have done it and are doing it, and then you'll just be another person who's buying and collecting real estate. So, the last 2 years of real estate have been literally insane, and there's no case study to handle a pandemic when no one was supposed to buy rent or collect rents in March 2020, let alone values going up during a pandemic, let alone there's countless things that have happened the last 2 years where it's like, this is insane. Like this, you can't even write this in a movie. So believe in yourself, believe in your market fundamentals, and just execute and hold yourself accountable, and good things will happen. Because if you give up, the last 2 years we closed 6 deals. In the last, in June of this year we'll probably do 6 deals. So it's like, I could have easily gave up and took a salary, but I believed in real estate and multifamily and my vision for my life. And it's been hard. I'm not going to sugarcoat it on the podcast and be like, hey, it's all high fives, rainbows, and big checks. It was a lot of work. So it's believe in yourself and keep going.
No, without a doubt, every deal has its trials and tribulations. That's part of the fun. It's part of the uncertainty. And, we were discussing that a little bit before this too. It's, we're sharing our journey on this repositioning on the deal we just purchased. And we're left saying, hey, boy, we just ran into a major issue on that first bathroom. And do we want to share the problem that day, or, hey, let's redo the bathroom first, and then we can share the major problem that we came into after we've solved.
I don't want to know what Bill did to that bathroom. That's a different podcast case study.
Well, it was the poor workmanship from the last landlord, and all the water that went underneath that subfloor, which we weren't able to see. But there's always a solution to every issue. Second question: what are your 1 to 2 year personal goals?
1 to 2 years.
Outside of real estate.
Outside of real estate, do more stand up. So I did stand up last year. Loved it. Absolutely loved it. It felt it felt like they talk in the sports movies where time slows down. You get to such a rush. I like to think I'm funny, but I made people laugh, so this is like the true test. But I listen to stand up every day, and then I want to write a book on how to asset manage. So those are kind of the two, because it's all systems, and it's, to be honest, it's selfish. So that here's how I asset manage, so I can have my like a virtual assistant do it. There's a lot of fact gathering, and you kind of just look at the numbers. So if I can do it with a virtual assistant, kind of running the show, and my parents are teachers, so if I want to be able to teach people how to manage their business, and I just know many people buy deals, but there's not as much content on how to manage deals and asset manage it. So those are the two goals in the next 2 years.
No, I love that stand up. That's not a common answer. Boy, that's exciting.
My accounting, I've done a lot of weird things, from accounting to real estate to stand up. So
Awesome. Yeah, awesome. You and Steven have something in common, and he has a couple parents that are educators also. Third question: how can we assist you, and how do we contact you?
You can contact me at ValueAddMike is like all my handles, because 0% of people can spell my last name correctly on the first at bat. So I figured make it easy for everyone. Email Mike at valueaddmike.com. To assist me, just keep doing you, Bill. I think I challenge anyone who ever wants to add value is to look internally at what is the one thing you're really good at, and then look around at the existing groups and see if they're doing that thing. So for me, it's like, I knew I'm good at spreadsheets, and so I was like, I will underwrite everything for free. Because I did that, I got the opportunity and the experience to work for where I'm at today. So I'm not saying I'm not saying be anyone else, just be yourself. Like if you're a content person, there's infinite ways to make content and make it better for groups. And then who knows how you can get in a deal that way. So double down on what you're really good at. Look and see if there's gaping holes in people's like content or whatever value you can provide, and then just do it for free, and good things will happen. I promise.
No, it's funny. It was pointed out to me over the last couple months. It makes so much sense. It's find your uniqueness and exploit it, and try to be of service to others, utilizing your uniqueness, and that's, I think, super valuable. Mike, it was awesome having you on the show. We really appreciate it.
Absolutely, Billy. Yeah, and I just want to touch on that because it's like, for me, it'd be insane if I was like, I don't want to do spreadsheets anymore, and I've been doing it professionally for 5 years.
Right.
So like, don't run away from what you're good at just because you don't like whatever's in your head. Double down on it. You're good enough. You can take over you can do whatever you want. And so just double down on who you are, and you will be successful. It's a matter of when, not if.
Great message, Mike. We appreciate you.
Yeah, absolutely, guys. Thanks for having me on.
Enjoy the weekend.